Hello, this is John from optionsmeister.com, and I want to present to you today a short video presentation on how to use delta in trade selection and trade management. Let's get started. I'd like you to take a minute just to review this slide, and this talks a little bit about what we do in OptionsMeister and what my vision, goal, and mission is for OptionsMeister. And the vision is really to educate traders and investors using known probabilities to become consistent and profitable traders. My goal is to show every client that successful trading is a learned skill. It doesn't require athletic ability or extremely high intelligence, etc., but it can be very mechanical and non-emotional. And finally, my mission is really to encourage and convince every trader and investor to become a self-directed manager of their own financial future. As we start this presentation, first of all, I think we should talk about what is delta. Now, if you've been trading for any period of time, you know the classic definition of delta, and I've put on this slide here for you. It's really, delta is the amount an option prices is expected to move based on a $1 change in the underlying stock. Calls have a positive delta. Those values are going to be between a 0 and 1, and that means if the stock price goes up and no other pricing variables change, the price for the call will go up. Now, puts, on the other hand, have a negative delta. So their values are between -1 all the way up to 0. And that means if the stock price goes down, no other variables change, the price of the put will go up. I know you're going to be questioning about whether we go, when we're short calls and short puts, and how those affect the deltas and whether it's positive or minus. And we'll get into that just a little bit later. Now, there are really two types of deltas. There are static deltas and they're dynamic. Now, static deltas, I'm going to cover those first because I think they're the simplest. They're the underlying stock, an ETF, or could be a future. One share of stock equals one delta. So if you're long 100 shares of stock, you have 100 positive deltas in that stock. If you're short 100 shares of that stock, you have 100 negative deltas in that stock. And static deltas are not affected at all by the change in price, implied volatility, or the days to expiration. They're always going to be the same. Buy 100 shares of stock that's trading at $50 a share and it goes up to 100, it's still only going to have 100 deltas. Conversely, if it goes down to 0, or 1, it's still going to have 100 deltas. So static deltas are exactly as they sound. They don't change. You can just equate one share of stock to one delta. Now, dynamic deltas, on the other hand, are what we typically deal with day in and day out, OptionsMeister and in regular options trading. They're options on underlying stock, ETF, or futures, because futures have options, futures options. Again, one option contract, as you know, controls 100 shares of stock. You can't buy an option contract that only controls one share of stock. So every option contract that you either own or you sell controls 100 shares of stock. Now, the dynamic option, the options we're talking about on these underlines, are materially affected by the change in the price of the underlying, the implied volatility, or the days to expiration. So these things are moving all the time. What you put on a trade and the delta is 20 right now, instantly could change to 21 or 18 just by a change in volatility or price. Obviously, the days are not going to change in that instant, but dynamic deltas are just like it sounds. They're moving and they're subject to change at all time. The greater the delta of the option, the more the price of the option changes. So what that means, if you reflect back on what a delta is, so let's just say we have a $50 stock and we sell or buy a $20 delta strike, and the price of that $50 strike goes up to 51. That call option or that call long option is only going to go up 20 cents. Now, if on the same $50 stock, if we have a 70 delta call and a long option and the price goes up $1, that price of that option is going to be affected by 70 cents. So that's a very simple explanation, but that's if you've been trading for some period of time, you've probably got your head around that pretty well. I want to talk a little bit about understanding delta before we move on. Again, I'm going to reiterate, call deltas are a positive number. And if you look on the chart below the option chain, you'll see a gold arrow number 1 shows that at the 299 strike, this particular underline has 44 long deltas. Now, on the other hand, the put deltas are a negative number. And if you look at green arrow number 2, you'll see that it has got it's short 44 deltas. So if I had a long put, I would be short deltas. If I have a short put, I'm long deltas. And that's what I know probably confuses some people, because you said, well, John, we're selling a naked put on XYZ company. We're selling this 293 put. So that's a minus times a minus equals a plus. That's why a short put is a bullish trade and a short call is a bearish trade. Because if we sell that 299 call with 44 deltas, we're going to be minus 44 deltas. So we're looking for the stock to go down, obviously. Now, how's delta used in options trading? I think that's the genesis of this that caused this little short video to be presented. With discussions we had in our group, but most of the trades that I do that we do in the gold level, if we're talking about a strangle, for instance, and we talk about the 1 standard deviation strangle or a 2 standard deviation strangle, you can really use deltas to indicate the standard deviation. And the 16 delta strike approximates the 1 standard deviation strike. And if you go down to the 5 or up to the 5 delta, up on the call side, down on the put side, around the 5 delta equates to the 2 standard deviation strike. And we kind of use those interchangeably. They're not 100% accurate, but for the type of trading we do, that's what we use. We like to, when we're looking for a 1 standard deviation strangle, we're going to the 16 delta call and the 16 delta put. Now, what that also means, the way they use delta, is similar to the probability of finishing in the money or out of the money. So if we've got our standard 1 standard deviation strangle, let's say, for instance, and we've got the 16 strike put and the 16 strike call, we know that there's approximately a 16% probability that price is going to close below that 16 delta put or above that 16 delta call. Now, where we deal is that area in the middle. We know that the price is going to move in between those two strikes, the 16 delta call, the 16 delta put. But that's where we focus our efforts and where the stock's not going to go. So we're comfortable in 1 standard deviation, knowing that about 68% of the time, price is going to stay within that range. Now, the other thing to understand, and might get a little confusing, is the net delta of options represents the net stock position in the account. And the other thing is the net delta option position is dynamic, just like we talked about regular options being dynamic. If we sell a 16 delta put, and we're going to sell a short naked 16 delta put, and we know that we've got an 84% probability it's going to stay above that, being the reciprocal of 16. We also know that if that stock moves down, the delta on that put is going to go up. So what was a 16 delta put before, might not be a 20, 30. If it gets at the money, it's going to be a 15. It's going to be a 50 delta. So that's why I explain how dynamic deltas can actually be in our options trading. Let me go briefly over the delta on the option chain. This is an underline that actually pulled off the Tastyworks platform. You can see the price in the middle is 46.30. That's where this one's currently trading. If you look at the number 1 up in the upper left-hand corner, that July 17th, 2020, that's the expiration date for this particular option chain. Everything will go worthless after the July 17th. Number 2 in the middle is 55 days. So from the date this presentation was put together, minus the July 17th, there were 55 days left in the option cycle. And then the number 3 to the right is the 59.7%. That's the implied volatility of the underlying on this particular option cycle, on the July 17th option cycle. And that plus or minus figure in parentheses is the expected move, what we talk about all the time. So in this particular case, it's $7.87. Let's round it off to $8. We've got a 1 standard deviation. The expected move is $8 between now and July 17th when this was done. So plus or minus $8. So it's telling us that with this thing trading at 46.30, you can add $8 to the top side would be 54.30, and you could subtract $8 to the bottom side, you'd be 38.30. So those are the ranges that we're expecting the stock to stay in, and I hope that's clear to everybody. I marked, in this case, it's something I want to point out, the 38 strike, as you can see on the put side, is a 16 delta, which is 1 standard deviation. On the other hand, the 16 delta call is the 60 strike. And you might say, well, that's a wide variation. It's different on either side, and that's what's known as skew. In this case, we've got the 38 strike put is the 16 delta, the 60 strike call is the 16 delta. And with the current price being at 46.30, you can see that there's an upside skew to this. So in other words, there's prospects of this moving up they've given you more room. There is another way to say it. So what you see here is simply delta skew. We're much further away on the call side than we are on the put side. And we won't drill into that right now, but just something to keep in your back of your mind. Right now we want to focus on deltas and how they are, impact our trading, how we use them in our trading. This is delta skew, and we alluded to it a little bit on the previous screen. Same delta or same option chain we just talked about, but you can see the price is currently at 46.30, and if I subtract 38, which is a strike, that's a difference of $8.30 to get to the one standard deviation or 16 delta put. On the call side, on the other hand, if you take the 60 strike, which is a 16 delta, you subtract the current price, 46.30, that's $13.70. So where the put side's only $8.30 away to be 1 standard deviation, the call side is $13.70 away to be a 1 standard deviation. What this is telling you is there's actually, in this case, a skew to the upside. And conversely, if you took the price, the 46.30, and you added $8.30 so that you're the same on both sides, that would be about around the 55 strike, which would be a 26 delta. You can see there on your screen. And conversely, if you took the 46.60, you subtracted the 13.70 that the call side spread, that would get you all the way down to 32.90, which is even off this particular chain. But that just shows you what can occur in delta skew. And it can be both ways. In fact, in most cases, you're going to probably see more skew to the put side than you are to the call side. Now, delta neutralize is something we talk about all the time in our trading and our trade management. In this case, this is an actual trade that I currently have on. It's a square June 19th, 90, 62.5 strangle. I have not adjusted it yet. It's ready for adjustment. The current price is 81.49. When I put it on, it was probably somewhere about in the middle, but you can see the price has moved up on square a little bit towards the call side. So right now we're in a situation where before we were about 16 deltas on both sides, plus or minus. Now we're way down to 7 deltas. You can see in the gold, what is encircled in gold there on the 62.5 put, and we're 26 deltas in the call side. By being short that call, we're short 26 deltas. So now instead of having a delta neutral trade where we're 16 and 16 or 20 and 20, now we got 26 and 7. And this merits us doing what we call delta neutralizing. What I would do in this trade, or what I will do in this trade, with that being 7, I like to look initially when a trade is the way it is right now. It's gone up a little bit, but it's only 26 deltas. It hasn't really been, that side has not been tested at all. I'll roll that put side up to neutralize those deltas to 50%. So half of 26 is of course 13, and if you look at where I've got circled in green, you could either roll this up to the 67.5 or the 70, and that would neutralize your deltas by about 50%. And that's simply all we're talking about when we neutralize deltas, and we talk about neutralizing by 50% until one side or the other is breached. When that happens, then we are more aggressive in our delta management. Now here's another current trade I have on. It bears taking a look at. This is just the opposite way. The current trade that is on is a 230-190 short strangle. The current price is 199, so in this case it's moved down. You can see the call side only has 8 short deltas because we're short the 230 call minus delta because the calls are a minus. That is short 8 deltas on the call side. When we go to the put side, we're now it's at the third. What was around 16 is because of the price of the stock moving down, because they're dynamic. Those are now 31 deltas. We are long 31 deltas there. Now you say, John, well, it says minus 31. Yes, but we're short. So minus times a minus is a plus. In this case, we're long 31 deltas. We're short 8 deltas. So the net delta position of this trade is 24 long deltas. Put in perspective, that just means you're effectively long 24 shares of the stock. Doesn't mean you own 24 shares or anything. It just means you're long approximately 24 shares of the stock. When we start out with a delta neutral trade, where both the call side and the put side are the same, those are delta neutral. We don't own any shares of stock. That's a neutral trade. That's simply what this means. Now, the trade adjustment I would do on this particular one, just the opposite of what we did on the other side. Since this has moved down, we want to roll our calls down to neutralize deltas. And we look at the short put side, it's 31 deltas. Half of that's around 15. So I would roll this down, the 230, probably down to 220. As I indicated on this slide. So that's 17 deltas. So now we'd have a trade. Our strangle, we'd keep our 190 in place. We would roll our call down, and we'd have a 220 by 190. Now we'd be back to closer to neutralize our, not completely neutralize our deltas. We're trying to neutralize it by 50%. But you can see we would be short 17 deltas, long 31. So what is that? We'd be effectively long 14 shares of stock. Well, I hope this was some benefit to you. Gave you just a little overview of that. I'm going to go into another video to much more detail on trade management, because I know that's an important concern of everybody. But if this interests you, if you're not a member of our gold level and you want to take a look, you can review this chart. And we have a nice small little group. We actively trade every single day. That there's trades available. I post all my trades in real time. I post all the adjustments, the exits. You basically got access to me. You got a coach throughout the trading day for most of the regular trading hours. So you have a question on a trade that you've put on, you just either type in the chat or ask me, and we'll address the question. So if you're interested in our gold membership and want to really become an active trader, please reach out to me. And catch me on Skype. You can catch me on our Facebook options trading group. Or send me an email, john@optionsmeister.com. Thanks for your attention. I hope this was some benefit to you, and look forward to the next time we get together. Thanks.